Okay, we're live here. Um, Very excited to see everyone come in. I'm Howard Marks, I'm the CEO of StartEngine, and I have with me Kevin O'Leary, who is an advisor and for StartEngine, also an investor, and he's also a commentator. Welcome, Kevin.
Thank you so much, Howard.
So we're going to let people coming in, and what we're gonna do today. The agenda is very simple. We're going to talk about our 2024 financials. We released that already last week, and then Kevin and I will have a little conversation about what's going on with Start Engine, and then after that we'll take your questions. The whole thing will be half an hour. Kevin has some massive commitments with the networks, so we have to be very, I would say, respectful of his time. So, welcome again, everybody. Let's get started with the first slide. So, I want to remind everyone what our mission is. Our mission is to help entrepreneurs and investors to achieve their dreams. So, here's what's going on. So, we released our 2024 numbers, and as you can see, we were able to double our revenue year over year from 2023 and 2024. Um, in terms of, if you look at, we have all the details here: cost of revenue, gross profit, sales and marketing. You will see that we're still not a profitable company. However, the last quarter of the year, we were able to get some form of profit, which we call it EBITDA, which is earnings before interest and depreciation and amortization, of 1.3 million for the last quarter. So we accelerated in terms of our revenue the last quarter. We also decreased some of our costs. We reduced about our operational costs by several $1 million at the end of the year, which we're going to see the benefit this year. And we still had a net loss, by the way, in fourth quarter. Where it's called GAAP, the General Accounting Accepted Principles. And the stock options, there's costs that are non-cash that we've had, amortization of one of our acquisitions, things like that. But anyway, what I want you to see is that we were able to grow our revenue principally because we introduced this new product line called Start Engine Private, which I'll talk in the next slide. So what is Start Engine Private? Very simply, is a lot of our investors wanted access to some other kinds of companies in the private equity market. I would call them more mature. Some people call them pre-IPO. What are those companies? These are companies that are very well funded by venture capitalists in the hundreds of millions, if not billions, and they have revenue, track record, and typically companies like that, you'll see them going on the stock exchange market. You'll see them being acquired or merging with other companies. There's a lot of activity in that. So these companies, valuations between 1 and 60 billion, pretty massive in terms of the size. We were able to create funds around them, and those funds are offered to our investors, and our investors are able to invest in anyway from 10,000, 15,000 to 30,000 minimum investment per fund, depending on the fund. And those funds are limited to 100 investors each because of because of the regulations. It's been an incredible opportunity for our investors. That has helped our revenue grow significantly. And then you can see this here. If you just take private, it's really started a year and some ago, and we were able to just grow it quarter over quarter. And again, as I mentioned to you, the appetite from investors is pretty strong. So anyway, the overall doubling our revenue year over year has been exciting. That shows growth for our company, and it's something that we're really looking forward to it because it shows that by diversifying a product line, we're able to take our existing assets, the large investor base at Start Engine, and give them more things to invest in. And we would like to continue to do that. So we're not announcing today any new product lines. We're not announcing future revenues or profits. What we're announcing is what we did in 2024. As you know, as a company, we don't do any forward-looking statements. Anyway, so Kevin, now that I've made our, I would say, shortened announcement, tell me, as a commentator in our market, what do you think?
I think the overall venture market is going through a pretty big change right now, and all kinds of alternatives are going to grow faster than the traditional venture model has been around for a long time, because most companies want to tap their communities that they're creating. If you see where the most sticky investors are, they generally are the people that are using the product or service, and when the company offers equity, they tend to hold on to it during the period they have a relationship where they're part of the community. So I think that's important. The bigger opportunity longer term is going to be that equity crowdfunding is going to morph into the form of tokenization of securities as well, and free trading tokens on blockchain technologies. And this is a huge moment because previous administrations blocked all that. This one has formed a group, a committee, to explore all of these alternatives. And I believe for the first time in the next few weeks, maybe right after the reconciliation bill, the Stablecoin Act, now called the Genius Bill, it's headed up by Senator Haggerty. This is just for digital payment systems, but the reason it's significant, it'll be the first crypto bill passed on a bipartisan basis, and will open the floodgates for other legislation to follow, to bring all this technological development back to the U.S. away from other places where it was chased away through litigation in the previous administration. So these are great times for this, and I think StartEngine's sitting right in the middle because it's already got the platform. The key is the Know Your Client platform. It's still going to have to be compliant with the SEC, but all of these other alternatives, including what you just detailed on private equity, and it was obviously successful because there's huge demand for it. But tokenization will be the same, and it's going to require platforms like StartEngine to actually have the mechanics and the infrastructure to pull it off. So it's a stay the course and continue to provide the services that venture capital always requires. And I'm very kind of bullish over the next 2 years in terms of where this is all going to go.
Well, thank you. I wanted to get your opinion. So my friend Larry Fink, he made a nice letter, a nice newsletter recently where he talked about access to private equity. Typically, they, as a firm, have dealt with public securities, public debt, and recently they've made some acquisitions in the world of private equity. He believes that a portfolio of an investor should not only be just regular securities that are traded and bonds. They usually talk 60-40, as you probably remember the allocation. But now he says, no, it should be 50, 30, 20, 20 being private equity. And that's what we do, right?
Yeah, no, exactly. But the numbers tell the story. I mean, it's clear he's signaling that alternative assets in terms of getting overall returns are crucial in a portfolio. And I agree with him. And that's the way I invest. I might add also, Howard, that Fink was the most advanced in terms of tokenization. He, in fact, has a token on the blockchain, pays distributions for accredited investors only. He developed that and put it out there before anybody else did. So it's opening the floodgates for these types of securities, accredited investors first, but I think unaccredited investors with smaller amounts of capital can also use this. So it's all coming. The fact that he was able to do that with a behemoth fund that he's using and got the SEC on board just tells you this administration is going to open up to these alternative asset classes and different ways to distribute them.
Yeah, so we're looking forward to it. As you mentioned, the cryptonizations of securities. We are regulated by the SEC, and FINRA is our supervisor, and they know that we're interested in crypto, but we also only want to do it per the regulations. We're not a firm that was interested in trying to test the regulators with some, interesting new business models that they haven't approved for us to use. So we haven't done that, but we are ready. I can tell you we're more than ready as to how they're going to tokenize securities. We will be there. And we have a trading platform as well that has been approved to trade, and we trade today on our platform. So we're ready for the world that you're describing right now, the tokenizations of securities, the ability to trade them. However, regulation has been, as you know, a difficult one in terms of how we market these platforms, how we talk about those platforms. It's been very restrictive. So again, we're looking forward to it. But the idea that we can offer investors today, waiting for the tokenizations of securities, private equity for their portfolio, I think that's pretty interesting.
Yeah, and investors should take advantage of it. I mean, it's not as liquid as a stock or a bond, but it's shown to have pretty attractive returns over long periods of time, and so that's why it deserves to be in a portfolio. This is the largest allocation Fink has ever been an advocate for. Usually, it was sort of 5 to 10%. 20% is huge, and I think a lot of people are going to look at it and wake up looking at that, saying how they've underallocated for this important asset class.
Well, I can tell you something. We talked to thousands and thousands of investors, and I can tell you this. Most of our investors traditionally have not had any private equity. That means stocks in companies like the ones we offer, whether they're startups or mature companies who are what we call sometimes pre-IPO. But they also don't have any real estate partnerships. They don't have access to collectibles. They typically have not done much. Now, those who came on our platform started investing and started building a portfolio of private equity with us, and that is true. However, we're still talking about a small number of investors. You're talking about the tens of thousands, hundreds of thousands, but not in the tens of millions. And we've looked at the market, and there's about 15 million accredited investors there's 30 million accredited investors, but really half of them are able to make investments today in private equity. Why they're not?
Well, they don't have the vehicle to do it. If you go into a private equity fund, it's very onerous. You almost need a family office and a team of lawyers to go through just setting up the structure to own it. And, I think that's very difficult for the average investor. And the StartEngine's strategy, it's already proven. You've seen what happened. You saw what happened when you offered SpaceX and whatever. There was huge demand for it. And that'll continue. I know that the markets are very, very volatile right now, but this too will pass. And by the way, markets have 20-25% corrections all the time. And even after this correction this morning, even after the 1,000 points, it's still trading at a 17 price earnings ratio, which is normal for long term. It came down from 23. So if anything, it's probably a buying opportunity. I don't recommend people when to buy, when to sell, because I can't time the market. I just stay the course. But I have added to my positions recently, and I'm beginning to nibble, and I have no idea when it's going to bottom. But generally speaking, 100% of the time, big corrections are great buying opportunities if you have a 5-year horizon.
Yeah, I think I agree with your analysis. The long-term course is important. Private equity, again, what I advocate for investors is the following. Say, look, we can't predict short-term markets. It's just too hard. But if you want to invest in the future of our economy, we're talking about AI companies, tech companies, infrastructure companies, AI chip companies. We think these are interesting investments on a long-term basis for your portfolio. The volatility will be unknown because, again, they're not trading at this point, so you can't mark your portfolio. But on the other hand, the 50% in tradable equities, 30% in bonds that are also liquid, and then 20% in private equity, I think it signals a new era in portfolio management.
100%. It's just a matter of, people take time to change their ways, but performance drives everything, and performance on private equity has been stellar.
Well, I can tell you this. The demand we've seen from our investors is pretty strong, so we're excited. Let me take our first question from one of our investors. The first question is, what is StartEngine's business model? Do you charge investors or founders? What model is it aligned with investors' returns? So our model is different depending whether we talk about our private, which are funds, or do we talk about our crowdfunding, which is raising capital for companies. So let me address first our funds. So StartEngine has several dozens of funds that we put together, sometimes around one company, like for example, Perplexity, or sometimes a mixture of 6 to 8 companies. In that model, we get paid the following ways. We get an acquisition cost. We purchase the shares and then we sell them. We disclose our purchase price. We disclose, of course, the sell price, so you know what we're making in between. And then also we get 20% of the profits down the road when we liquidate the fund, when we are able to sell the stock. This is how we do it. We are aligned in terms of the long term because obviously if the stock does well, we will make more money. Now the other thing is on the crowdfunding, we get a fee, and then our fee is in two portions. One is in cash on the amount raised, and then the other one is in stock on the amount raised. And stock at the same price as the investors are paying. And that's how we are aligned on the crowdfunding. So I hope that answers the question. Our next question is, and I think that's where Kevin, who is really positioned today as an expert in this topic, considering how important tokenizations of RWAs are, should StartEngine consider purchasing one of those companies to stay ahead of the industry? What do you think, Kevin? Should we do it ourselves, or should we go out and seek an acquisition to be able to participate in this tokenization?
This is a dilemma I've faced in many investments I make, and I'll give you an analogy that I think is apropos to this. I'm a huge watch collector, and so one of the pain points in the watch market is watch insurance. Most watch insurance programs are tied to home packages, which reflect appreciated values, but most watches appreciate in value if they're mechanical over time. So you end up getting, take a Rolex Daytona or something. If it gets stolen 10 years later, you get offered $1,200 for a watch worth $58,000. So I decided to go out and buy an insurance broker to start offering. I was going to solve for my own problems because I wanted to just insure watches that were outside of the vaults and that I was traveling with, so I could turn on and off the package. And I realized that over time that most of the deals I looked at hadn't figured out customer acquisition cost. They had a really hard time acquiring customers. And in fact, for many of them, every new policy they wrote, they were losing money on. So that didn't sound too good to me. And I think there's a good analogy into what StartEngine's done. You already have a huge base of investors. And so my reaction is to launch it from within StartEngine and see what the customer acquisition costs are like before you acquire anybody, because social media and online messaging and large bases of consumers that are already in the community of StartEngine are far more valuable than most entities you try to acquire. That's my take. And it lets you measure how successful you are on a ramped basis, and you're quantifying how much you're investing in it. I'm glad I did it that way. I'm pretty happy with the business now, even though it took me 2 years of investing before we started to even issue policies. But the whole point is, we figured out CAC, we figured out customer acquisition, and we have solved for that, and that lets us grow almost geometrically because we're profitable on every policy. So my answer is, don't buy anybody, build it yourself.
Yeah, I agree with you on that 100%. We have developed some technology in the past that we never deployed for storing and trading tokenized securities. We never deployed for a good reason, because again, the regulation out there has to be available to us through SEC and FINRA. And again, we chose to use regulation crowdfunding, regulation A as our principal platforms. And to the extent that they will make them tokenized, we're in 100% in. We will do it. One other question I just got is, will we allow people to use Bitcoin to buy securities? And I'm glad that question was asked, because Kevin, you mentioned there's a new bill coming out for stable coins, which are the ones that Tether, Circle offer, right?
Yes.
And so we'll be able to use those down the road to purchase securities, right?
Yeah, I think that's the whole idea. But I want to add one thing. If that bill passes, and I think right now it has bipartisan support, highly likely it does, the next bill coming will be the Crypto Market Infrastructure Act, where we will finally determine which tokens are equities and which are commodities. For example, is Ethereum, also a heavily traded asset, is that a commodity or is that a security? And once that's resolved, it makes life a lot easier for people to build portfolios of diversification, knowing that, well, this asset is securities and it's regulated this way, and this is a commodity like gold or oil and it's regulated a different way. All of that is going to be determined in the Infrastructure Act. And so there's a lot of interest in getting this resolved now. It's not policy by litigation didn't work. That's what Gensler was doing, and I respect Gensler, but his strategy didn't work. He just ended up with a whole bunch of people fighting back. And they still haven't resolved all the litigation. Some of the operators, I call them the crypto cowboys, are in jail or serve time there. And all of that stuff we're past all that, and now we're into the world where we're trying to integrate crypto into financial services. And I don't see any reason why StartEngine can't be a leader in that, because it already has the infrastructure, already has the investors. My guess would be 30% of the investors that are already on the platform of StartEngine would love to have some USDC in their account to use it as a payment system, even maybe get some yield on it, because right now it's offering 3.8%. Which is better than savings accounts in banks, and yet it's backed 1-to-1 for the US dollar. So a lot of this stuff is, we're at the beginning of the cycle, and that's why I'm pretty optimistic about where we end up with in 2 years.
I agree with you on that. One question we just got, which is the elephant in the room, the tariffs and the thoughts about the effects on the geopolitical, economic forces, StartEngine. What is StartEngine? The world at large, what do you think, Kevin?
Tariffs don't have a lot of effect initially on financial services. It's more about what they do to the economy over time. I'm in the camp that says we're in a giant negotiation. We just in the last few hours found out that Europe, which is probably the largest aggregate group, has proposed 0 tariffs in both directions. That's the first time ever since the Eurozone was formed that they've considered that. And so, if I'm Trump, I'm feeling pretty good, even though I've rocked the market. We've basically lost $7 trillion of market cap to try and resolve a $1 trillion trade deficit. So, the pain has been felt already. But I think if a deal was cut with the European Union and no tariffs on any sector, you would resolve a lot of issues like automotive parts, farm equipment, the stuff that Germany doesn't allow into its country, made in the US. Immediately overnight, there'd be access to those markets. And I think if that happened, the other 59 countries would immediately look at that deal and want the same. So you start to resolve things pretty quickly. The next would obviously be Canada, saying we'd like to remove all tariffs in both directions, particularly on energy. So I'm actually optimistic that, yes, it's going to be volatile, but you can't time the market. The minute the market sniffs that there's a resolution to this, it's going to have a violent trend up. And if you miss those trading days, you miss most of the performance. I remember the first year of the pandemic in 2020, 2021, about 11 days attributed to the entire gain. They were violent days. I mean, crazy, up 2,000, down 2,000. Kind of what we're seeing right now. And so stay the course and just wait and see what the outcome is.
Yeah, I agree as well on that. We cannot time the market. We can't decide what's going to happen. But on a long-term basis, there's a lot of potential. And in terms of where the tariffs are going to end up with, I have no idea. And the good news is that's not my job to figure this out. My job is to help our investors get access to private equity, exposure to private equity, and now that Larry Fink is saying it, I can easily say, look, we agree. We think investors should allocate a portion of the portfolio because that's how the large wealthy investors do it. That's how the family offices do it. That's how large hedge funds do it. I mean, it's amazing to watch that private equity has been a behind the scenes, very quiet type of investment behavior when it represents probably 80% of the economy. It's, in terms of real assets. So I'm excited about it. So let's see the last question before we end. they asked me, do you have plans to expand in artificial intelligence, other sectors? What are you going to be looking at? So I'm glad we have Kevin, because he sees the entire market and better than anyone. So tell me, where do you see us targeting for private equity? What are the areas we should look at?
I think service providers that are aggregating AI services, if you look at small business, which represents about 62% of job creation in America, those are companies 5 to 500 employees. They can't afford to develop AI stacks, but they do want to use the services, particularly in the areas like creating content for social media for their communities of not just investors, but actually customers. So if you're trying to acquire customers now in a typical company with 200 people, you want to use the tools that make your CAC, your customer acquisition cost, as low as possible. And so I'm seeing a lot of these aggregators coming together saying, look, here's for a package for $49 a month. You can use all the tools. That's an interesting area. It's a new career job. I mean, I'm trying to hire these people myself, experts in AI, using all the different providers to figure out which one to use on the business level. But in terms of investing, I think that the biggest opportunity I've seen, and I've certainly pursued, is in real estate of data centers in North America. I've always been a big real estate investor in commercial real estate, but now we're seeing insatiable demand. There's a demand for 45 gigawatts of data centers in the US. There's only 5 gigawatts under construction. So I have several projects in that area. They're very large. Each gigawatt, just the power generation, is 18 billion. The total project is about 60 billion. So they're massive. And I think there's going to be a way to syndicate some of that, Howard, because the returns on these data centers are sort of in the double digit, 11 to 17%. That's why you're seeing all these giant funds being created, BlackRock, Blackstone, you name it. There's data center funds, but you need permitting, you need water, you need fiber, you need a community, and you're building something across as much as 2,000 acres. These are campuses. I like that space a lot because you're buying the infrastructure of AI. You don't know who the winners are going to be. You assume it's going to be a Microsoft or a Google or, something Sam Altman's doing, ChatGPT, that kind of thing. But you don't have to take that risk. You can just provide them with the services every single one of them need, a data center. And instead of, clipping coupons at 11% is not so bad. So that's kind of the way I'm looking at it. And I certainly spend a lot of time in that space. About 40% of my day, I'm doing data center projects with states and governors and everything else.
Yeah, I agree. That's a good opportunity. We offer a lot of infrastructure from the perspective of the ones who create the software layers, the chips, and we should be looking also obviously on the ones who create the servers and the data centers and the real estate. There's so many areas that could be interesting. So I want to thank you, Kevin, again. You have such a great perspective on the market. I think in some ways you count people down, which is great. We'd love to hear that. Volatility is never good, and I feel a lot more, certain and excited about our mission, our opportunity to provide private equity for investors. And this, I think, is great. So thank you again, Kevin.
Thank you, Howard. See you again soon. Keep up the good work.
Thank you. Take care. And thank you, everyone, for joining us. I really appreciate it. And we'll talk soon. Thank you.